Hello, good evening. Trust we are doing well. I can see somebody is greeting. All right. Once again, good evening. Our class will continue from where we stopped at the last time. Of course, we're looking at cost of capital. Sorry, we are looking at capital structure and theories of gearing. A quick recap of our last class. We look at capital structure, where we define capital structure as the different types of finance the company has utilized. A company capital structure is basically the company's financial structure. If you take statement of financial position, on that statement, you are going to see the non-current asset section. You have the current asset section. You have the current liabilities. You have the long-term liabilities. Then you now have capital and reserves. How the company is being financed. So capital structure basically is the combination of different types of finance the company has employed to carry out its business objective. We explained that the capital structure can include ordinary share capital, equity reserves, preference share capital, and long-term debts, long-term borrowings. We explained this. We explained the concept of risk, that risk can be discussed from two perspectives. We have the business risk, we have the financial risk. Your business risk has to do with the nature of the business you are doing. Your financial risk will come to play if a company has borrowed money. Financial risk occurs because the company has obtained debt finance. We emphasize that where a business is financed by equity only, such business will only be exposed to business risk. And the index that measures business risk is the asset beta. As soon as a company introduces debt finance into its capital structure, that means the company has introduced financial risk. Financial risk is the risk over and above the normal business risk. Of course, where a company is financed by both equity and debt, that means the company will be exposed to both business risk and the financial risk. The index that measures the risk of a gear company, the index that measures the risk of a gear company is what we call equity beta. Once you see equity beta, that implies that that business is a geared business. We explain this. We explain the theories of gearing. First, we started by saying that what is gearing? Gearing is the proportion or the percentage of debt capital in a company capital structure. Gearing is the percentage or proportion of debt capital in the company's capital structure. Where a company have excess debt finance, such company will be regarded as highly geared. Where a company has less debt finance, small proportion of debt finance, then we regard the company as lowly geared. Where a company is not financed by debt at all, such company can be regarded as all equity finance or zero gearing, ungeared. We look at the measurement of gearing. How do we compute gearing? We emphasize that gearing should be calculated with respect to market value. Thereafter, we look at the theories of gearing. We have the traditional theory of gearing that says that gearing has impact on companies' market value. The traditional theory of gearing says that capital structure of a company will have impact on its market value. This implies that capital structure decision is relevant to company's market value. Capital structure decision is relevant to company's market value. That is the position of the traditional school. We look at Modigliani and Miller. In the absence of corporate taxation, M&M argues that where there is no taxation, then capital structure decision is not relevant to company's market value. If you like, finance your business with equity. If you like, finance your business with debt. If you like, finance your business with combination of equity and debt. This will not have impact on your market value. This is the position of Modigliani and Miller, where there is no corporate taxation. We also look at M&M, where there is corporate taxation. The position of M&M, as soon as we introduce tax, is that capital structure decision will have impact on the company's market value. Gearing will have impact on the company's market value. Hence, companies should utilize more debt finance. The more debt finance you use, the company will enjoy tax relief on interest payable. The tax relief can be used to reduce the cost of capital. Reduction in cost of capital will enhance the company's market value. That is the position of M&M with corporate taxation, where corporate taxation is included in their model. We look at this and we said these two models are the major model. These two theories, the traditional theory, and Modigliani and Miller are the major theories of capital structure. However, we have other theories. We have the trade-off theories, we have the pecking order theory, and we have the market timing theory. We explain all this. Thereafter, we look at a question. Of course, for time reason, we cannot complete that question. And we suggested that we should try to solve the parts. We should try to solve the part A, Roman figure 2 of this question. Like I said on that platform, 2 students responded, and the responses was very fine. However, we are going to round up the question tonight. All right. We have taken a recap for like 10 minutes. We can now move to that question number 1 again. Let us see how far. Of course, all things being equal, by God's grace, we are going to need the question today. Any volunteer can read. Let's read the question again. Any volunteer? Please, can somebody read the question for us? I know there must be volunteer. Any volunteer? Yes, who is reading? I will have to mention him. Nobody is willing to read. Now, wow. So who are we calling now? Who are we calling now? Somebody should read for us.
The finance director.
All right.
The finance director of Cooper PLC is concerned about the impact of capital structure on the company's value and wishes to investigate the effect of different capital structures. He is aware that as gearing increases, the required return on equity will also increase, and the company's interest cover is likely to decrease. A decrease in interest cover could lead to a change in the company's credit rating by the leading rating agencies. He has been informed that the following changes are likely.
Okay, let me move forward. Let me move again. He has been informed that the following changes are likely. We have the interest cover, credit rating, cost of long-term debt. Please continue.
Okay, so we have the table showing the interest cover, just like you said. They said the company is currently rated A.
Please note, company is currently rated A. That means if this company is currently rated A, the cost of The cost of debt is 9%. All right. Next.
Okay. We also have the summarized financial data for this company. We have from net operating income, depreciation, earnings before interest and tax, interest, taxable income, tax, net income, capital spending, as
Tax
shown.
is 30%. Note it.
Yes. And we're also giving additional information that the market value of equity is 458 million and debt is 305 million. Cooper's equity beta is 1.4. The beta of debt may be assumed to be 0. The risk-free rate is 5.5% and the market return is 14%. The company's rate of cash flow may be assumed to be constant and to be unaffected by any change in capital structure. We are required to A, determine the likely effect on the company's cost of capital and corporate value if the company's capital structure was 80% equity, 20% debt by market values, 40% equity, 60% debt by market values. Recommend which capital structure should be selected.
Let's pause there first. Let's deal with that. Let's deal with that first. Thank you. You can mute. Now the question says, or requirement says, determine the likely effects on the company's cost of capital and corporate value if the company's capital structure was 1, 80% equity, 20% debt by market values, 2, 40% equity and 60% debt by market value. Recommend which capital structure should be selected. All right. We have started this question. I'm trying to open our previous solution. Okay. Okay. Now, please confirm you can see my screen being shared.
You can see that.
Please confirm you can see my screen being shared.
Yes. Yes.
All right. For those that were in class last week, we treated this. We started with the capital structure, the existing capital structure, value of equity, 458 million, value of debt, 305 million, total value of company, 763 million. We calculated the percentage. Equity percentage currently is 60%. Debt percentage 40%. And we said the existing capital structure is 60% equity, 40% debt. You know, like I said, for me to know the impact of the new capital structure on cost of capital, then I must know the existing cost of capital. I must know the existing capital structure. You must be able to interpret questions to yourself. You want to determine the likely effect on your cost of capital and your corporate value if the capital structure is now 80% equity and 20% debt. You are not going to ask yourself, what is the current capital structure? We are changing to new capital structure. Let me know the current capital structure. That was what informed working one. Our current capital structure is equity 60%, debt 80%. Next, I want to know the current cost of capital. We computed the current WACC, we started with the current cost of equity. Using CAPM, we derived 17.4. The current cost of debt, because the company is currently rated A, cost of debt is 9%. Then we now proceeded to working three to calculate existing WACC. And our existing WACC was calculated as 12.96. The page 2 of last week working. We move to page 2. Now look at it, new capital structure. We are now moving to new capital structure 1, 80% equity, 20% debt. And we mentioned that as soon as you observe that the company capital structure has changed, as soon as you observe, because there's 95% chances that you are going to deal with something like this in your exam. Immediately you observe that the gearing ratio has changed. Please know, when we say gearing ratio, it's also the capital structure. Once you observe that the capital structure ratio has changed, it means that that equity beta, let me go back to it. Let me go back to page 1. Where's my mouse? Now look at this equity beta. Or let me come here, please. Let me come to the question. Look at this equity beta. This equity beta of 1.4 is based on existing capital structure. This equity beta of 1.4 is based on existing capital structure. And the existing capital structure is 50% equity, 40% debt. As soon as we observe that the capital structure has changed, that means this equity beta of 1.4 is no longer valid. immediately you are going to ungeared, the equity beta. Immediately. When we say ungeared, it simply means convert equity beta to asset beta. When we say ungeared, it simply means convert your equity beta to asset beta. When you are converting, you are going to use the existing capital structure, which is 40% equity, 60% equity, 40% debt. We explained the formula for asset beta. You ungeared. Once you ungeared, you observe that the answer you are going to get is going to reduce. From 1.4, we got 0.9545. That is our asset beta. Technically, you have removed the existing capital structure of 60% equity, 40% debt. When you are done with that, you now move to your next working. You are going to re-gear the asset beta obtained in the previous working. You are going to re-gear. When we say re-gear, it simply means convert asset beta to equity beta using the new capital structure. When we say ungeared, it simply means convert the asset beta to equity beta using the new capital structure. That was what we did here. Look at working 5. We converted and we got 1.122. The new equity beta we have gotten now represent the business risk and the new capital structure. You now use this new equity beta to calculate your cost of equity. That will take us to working 3. Look at it. We calculated new cost of equity using the new equity beta we have computed. We got 15.04. We have gotten cost of equity. Our next working is, what is the cost of debt at the new capital structure? What is the cost of long-term debt since the capital structure has changed? From the question read, examiner says, let's go back to it briefly. From the question read, look at it. Cost of debt is dependent on the interest cover ratio and the credit rating. We now come here, our last working, that our cost of debt is dependent on the interest cover ratio and credit rating. That means I cannot determine cost of debt as structure until I'll calculate interest cover ratio and determine credit rating. That implies that we cannot determine the cost of debt at the new capital structure of 80% equity, 20% debt, until we are able to calculate the interest cover ratio. We now try to calculate the interest cover ratio. First, to calculate your interest cover ratio is calculated as your profits before interest and tax divided by the interest expense. Your interest cover ratio is calculated as your earnings before interest and tax divided by the interest expense. In the question, we are given the earnings before interest and tax to be 90 million. That's okay. We pick that figure. We now come here and say, okay, the new capital structure is 80% equity, 20% debt. That's okay. Determine the value of the new debt. 20% of total company value. Total company value is 763 million. We now calculated 20% of 763 million. That gave us 152.6 million. That is the new debt, the new value of our debt. We now assume that, okay, if the cost of debt remains unchanged, what will be the interest expense? We now apply the existing cost of debt, 9% of 52.6 million. That gave us 13.734 interest expense. We now use this to calculate our interest cover ratio. Our interest cover ratio gave us 6.55. That means the interest cover ratio is above 6.5. From the data given to us, more than 6.5, that company should be rated AA. And hence, the cost of debt should be 8%. We now pick cost of debt to be 8%. That is under the new capital structure, 80% equity, 20% debt. With this information, we can calculate new cost of capital, new WACC. We computed the new WACC. Of course, please note, if you are calculating WACC, when you get to your cost of debt, taxation will be used to reduce the cost of debt. WACC is calculated as using post-tax cost of debt. And we got our new WACC to be 13.15. We can now explain the effects. Before, the cost of capital was 12.96. As a result of changing the capital structure from 60% equity, 40% debt to 80% equity, 20% debt. The company cost of capital increased. We can now explain the effect that, okay, if capital structure is changed to 80% equity, 20% debt, the company cost of capital will increase. This was where we stopped last time. We can now move to A Roma figure 2. 40% equity. Assuming the new capital structure is now 40% equity, 60% debt. What is the new WACC? That will now be our next working. Any question, please? We have tried to bring the previous knowledge to assist the class. Now, please confirm you can see my new whiteboard being shared.
Yes, sir.
All right. I will now come here now. This will be our page 4. Page 4. It should be my working 6 now. And I have new capital structure, new capital structure. I will now put Roma figure 2 now. 40% equity and 60% debt. Automatically, we are going to ungeared. We have done it before. We don't need to waste time on that again. Look at it. I'm looking for this tiny cursor. Look at it here. The ungearing is saying that means if you ungeared, we are going to ungeared using the existing capital structure. That means we are going to get 0.9545. So we are ungeared. We are going to have our ungeared beta is equal to 0.9545. Next, we are now going to regeared using the new capital structure. Look at it. Regeared. Please, I encourage us to always do our assignments. For the students that have done these assignments, they will understand better again now. Regeared. If I want to regeared and I want to convert this now, let me take this off, please. Regeared. The assets beta using 40% equity and 60% debt. I'll put the formula down. Assets beta is equal to, sorry, equity beta is equal to asset beta plus, open a bracket, asset beta minus debt beta, bracket, value of debt over value of equity, 1 minus the tax. I will come here. My BE is equal to, my asset beta is calculated as, that is the ungeared beta, is equal to 0.9545 plus, open a bracket, 0.9545 minus, we have been told to assume that the debt beta is 0. This is 0. Close these brackets. Value of debt, just pick the percentage, 60. Value of equity, 40. Bracket 1 minus the tax rate is 0.3. Please, what is our new equity beta? Please, what is our new equity beta?
$1.957.
1.957. Thank you. Our beta is equal to 1.957. As soon as you are done, the next thing is to calculate cost of equity, new cost of equity. Using CAPM, cost of equity is equal to, the risk-free rate is given to be 5.5 plus the beta factor is now 1.957 bracket, return on market is given to be 14 minus risk-free rate 5.5. Please, what is the cost of equity? Please, what is cost of equity?
22.13%.
22.13%. Please, if you don't understand, let us speak out. You know, even I deliberately, I even feel I'm even slow. I deliberately slow the class because although it's only God that can say what the examiner will text, but we are looking at it that this topic, cost of capital, was not tested last diet. It wasn't tested. I'm not sure it was tested upper diet. So there's a possibility that the examiner may take maybe 20 marks question for here. So it's only God that can speak with 100% certainty. Now you are done with your cost of equity. Next is to come and calculate cost of debt. That will take us to working 7. Our cost of debt. The cost of debt we are looking for is cost of debt if the capital structure is 40% equity, 60% debt. Now come here, cost of debt. Cost of debt. Remember that cost of debt is dependent on interest cover ratio and credit rating. That means we need to calculate interest cover ratio. We now come here. I want to calculate interest cover ratio. Then I should start with earnings before interest and tax. This is equal to 90 million. Then I need to calculate interest expense. I will now move down small. I want to change the ink. I'll move down a bit now. I'll take this as notes. Let me put it on small. Notes. First, calculate new debt value. We are told that the debt is now our value of debt, We are told that this debt is now 60%. Now compute 60% of total value of the company. Total value of the company, if you recall, is 763 million. Please compute new debt value. 60% of 73. Sorry. Oh, yeah.
457.8.
457.8 million. Okay. We now assume that, let us assume that the cost of capital will not change. So the cost of debt will not change. Our existing cost of debt is 9%. Now, please compute interest. Come here. The interest. Let me shorten this. 9% of 457.8. What do you have, please?
41.202.
I can come here and say the interest is 41,202. Now calculate interest cover ratio. Divide earnings before interest and tax divided by the interest expense. What do you have, please?
2.184.
2.184. Now we can go back. Our credit rating. Yeah, credit rating. We can go back. If your interest cover ratio is 2.184, that means it's between 1.5 and 4. Is that not? It means the company will be rated BB. If the company is rated BB, then the cost of debt should be 11%. Can come back here. This company will be rated BB. That means the cost of debt is 11%. We have gotten cost of equity. We have gotten cost of debt. And we know the new capital. We can calculate new WACC. Let me open a new whiteboard. I can come here and do like this. Please confirm you can see my new whiteboard.
Yes, sir.
That will be page 7. Page 7. Now I need to calculate new WACC. Recall, okay, new WACC. Recall that we have 40% equity and 60% debt. Also note, our cost of equity is calculated as 22.13%. Our cost of debt before tax is 11%. Then I can calculate WACC now. My WACC, please let me also say that tax rate is 30%. T is 30%. Formula for WACC is equal to cost of equity multiplied by percentage of equity plus cost of debt after tax T multiplied by percentage of debt. The WACC is equal to I'll come here 22.1 multiplied by percentage of equity 40%, that is 0.4 plus cost of debt after tax 11. Let me remove that. Let me not use times 2 times. 11 brackets 1 minus tax 0.3. When you get your answer, multiplied by percentage of debt, 60%, 0.6. Please work this out and tell us the work.
$13.47.
The work is what?
13.47.
13.47. What is the effect of the new capital structure on companies' cost of capital? Yes. What is the effect of the new capital structure on the company's cost of capital? Yes, who is responding? What is the effect? Before, the company's WACC was 12.96. Now, as a result of change in capital structure, the new WACC is now 13.47. What has happened to WACC?
That's increased.
Hello?
That's increased.
That's increased. So if you have to comment on this, although we are still going to take the comments, if you are going to comment, the comment is a change in capital structure to either of the two new capital structure will result in increase in the company's cost of capital. A change in the capital structure to either of the two new capital structures will result to increase in the company's cost of capital. Hence, it is recommended that the company should maintain its existing cost of capital. Hence, it is recommended that the company should maintain its existing cost of capital of 60% equity, 40% debt. Because at this capital structure, the weighted average cost of capital is lower. You know, the lower your cost, the better your value. The lower the cost of capital, the better the company's value. If cost of capital is increasing, that company value is likely to fall. All right.
The first working, we had two scenarios for new capital structure. The first one got a lower WACC than the existing, while the second one got a higher WACC. So, but I think the analysis you are advising on still applies in the sense that for the one that is higher, which is the second one, it's best for the company to adopt the existing because it is a lower cost of capital. But the first scenario, which is 80% equity and 20% debt, actually had a lower WACC. I think that one had a WACC of about 12.33, if I recall.
Okay. This is what he's trying to say. If you have to do our result in summary, If you want to do summary of results, we have existing capital structure, existing capital. Please let me shorten this, but I don't like shortening it, because existing capital structure. This is 60% equity and 40% debt. We now have new capital structure. New capital structures. Structure is in plural, please. We have 1, 2. This is 80% equity, then 20% debt. This is for 1. For Roman figure 2, we have 40% equity, 60% debt. Now, cost of capital here. Cost of capital. This is 12.96. This is 13.15. And this is 13.47. What will be your recommendation to the company? Which capital structure should we maintain?
Existing.
Yes. Somebody is trying to speak.
Existing.
Existing is better. The company should maintain its existing capital structure. We have just treated part of the question. No? The examiner says, determine the likely effect on the company's cost of capital and corporate value. All the solution we have done so far is on cost of capital. We now move towards corporate value now.
Sorry, hello, sir.
Yes, we are listening, sir.
Okay, so I noticed something. The cost of capital for 80% equity. Sorry, the cost of equity for 80% equity, the first scenario. If you can go there.
Why not?
Okay, let me just say it. Okay, the cost of equity there is 15.04.
Okay.
I'm not sure. Maybe that's what I have in my book too.
Yes, you are correct. 15.04.
Yes, that is correct.
Okay, but for the second scenario, which is 40% equity, the cost of equity is now 22.13. Like they are using more equity and the cost is more, and yeah, they are using less, the cost is. So they are using more equity and the cost is less than the one that they are using less equity. So I now noticed that the stuff we use is different. I don't know the one that we made mistake. Or I don't know if I'm the one that made mistake. The value is it value of debt over value of?
No, is it better that changed? Is it better that changed?
No. Is
I
it
was
the
trying
better
to
that
go.
change?
I was trying.
Is the value of debt
I'm
supposed to
following
be 60?
your.
Is correct. Though.
I'm trying to.
Do you understand what I'm trying to say?
Now I'm following the sequence. You made a good point. You observe that when percentage of equity increases, cost of equity falls. Is that not?
Exactly.
Hello?
That's what I'm saying. Yes, that's what I'm saying.
Now, when percentage of debt increases, cost of equity rises. Is that not?
Yes, to compensate the equity holders for as debt is increasing. Yes.
I want the person making that statement to also confirm that yes. Now, like the last speaker said, if you issue more equity, cost of equity is likely to fall. If you are issuing more equity, because your risk is reduced, look at it. Before, the debt was 40%. Now the debt is now 20%. By reducing your debt, that means you have reduced financial risk. Therefore, return to equity holder will fall. Before, return to equity holder was 17.4%. When the debt was 40%, equity holder was getting 17.4%. As soon as we reduce the debt percentage to 20%, that means financial risk has reduced. Hence, return to equity holder will fall. You observe it. That is the position of the traditional school. As soon as you reduce your debt, return, that means you have reduced your risk. Then we cannot give you higher return again. Hence, under 80% equity, 20% debt, returns to equity holder. When we say return to equity holder, it's also the cost of equity. Cost of equity is now 15.04. Now look at it. When we increase debt to 60%, by bringing in more debt, that means you are increasing the financial risk. Automatically, ordinary shareholders will demand additional return. Hence, cost of equity is expected to rise. The cost of equity under 40% equity, 60% debt becomes 22.13. That is in line with the traditional theory of capital structure. Is that clear, please? Now, for decision making, it is the company will not only look at cost of equity. What concerns the company is the total capital, the total cost of capital. For decision making, company will not only consider cost of equity. Company will consider both cost of equity and cost of debt. Both cost of equity and cost of debt is what is fused together in weighted average cost of capital. Look at it. We have bring together cost of equity and cost of debt under weighted average cost of capital. It is this what you are going to use for your decision for the company. I hope that point is clear.
Please, I have a question, and it's not to stretch this. It's not to stretch it. Okay, you were asking Mr. Dairo whether
Very well, sir.
for a,
Thank you, sir.
okay. Please, my question, I was actually thinking that the WACC, when the debt increased, was going to come down. When the debt increased to, when the debt increased to 60%, I was thinking that the WACC was going to come down compared to the existing that had a lower debt because of the tax effects.
Oh.
Is it because of the credit rating attached to the interest cover that determine the cost of long-term debt that changed it? Because if the debt is increasing and the tax is higher.
Your thinking is not wrong. There's what we call optimum capital structure, where you must stop adding debt finance. This question is texted using the traditional theory principle. What it means is that this existing capital structure of 60% equity, 40% debt, the company has reached the optimum capital structure. At that point, the company must stop adding debt finance. Now, to further explain, it is true that if you bring in more debt, we expect the WACC to fall. But it will get to a point, as you are bringing more debt, the debt holder will now start demanding higher returns.
Okay, that is that table there that now have 11% for the higher.
Okay. Thank you. Okay. As we bring in more debt holders say no, because as you are borrowing more money, the borrower will say, look, my risk is now higher. You have borrowed money from bank A, bank B, bank C. That means you are borrowing more. That means if you want to give you more debt, the debt holder will demand higher return. And that was what gave rise to 11% cost of debt.
Yes.
Is that clear, sir?
Yes, it's clear now.
So
it's a trade-off, yes. I said,
according to the traditional theory of capital structure, once a company has reached its optimum capital structure, then the company must stop bringing debt finance. An optimum capital structure is achieved at a point where the WACC is lower. Look at it now. If you compare the three scenarios we have here, we observe that at capital structure 60% equity, 40% debt, WACC is lower. At this point, we must stop adding debt finance to the business because the company has achieved optimum capital structure. But that is good. The question is good. All right, if there's no question, we now move to corporate value. All right, I've shared a new whiteboard. In case you can't see it, please speak out. We are going to label this page 8. It's a serious matter. I will now come here. I think working 8 or 9, I'm not sure. Should be working 9. Now to talk of corporate value. Corporate value. Now let's go back to the question. Look at after recommendation, the paragraph. I will read. Any change in capital structure will be achieved by borrowing to repurchase existing equity, or by issuing additional equity to redeem the existing debt as appropriate. The current total value, the current total firm value. Please, what is the current value of this company, please? What is the current total value of this company?
763.
763.
Thank you. Examiner says the current total value, in brackets, value of equity plus value of debt, market value of equity plus market value of debt, is consistent with the growth model. Look at the growth model. CF1 divided by K minus G, bracket close, applied on a corporate basis, where your CF1 is next year free cash flow. Your K is the weighted average cost of capital, and your G is the expected growth rate. Companies' free cash flow may be estimated using earnings before interest and tax, net of tax, plus depreciation, minus capital spending. Full stop. State clearly any assumption, any other assumption that you make. Also, look at this note here. The company's growth rates of cash flow may be assumed to be constant and to be unaffected by change in capital structure. We cannot set to work. First, examiner say corporate value is calculated corporate value is equal to CF1 divided by K minus G. We are giving the question. And we are told that cash flow in year one, our CF1 is cash flow in year one. If you look at this very well, this is like dividend valuation model, free cash flow, in next year free cash flow. This is like a dividend valuation model. I can also say that corporate value is cash flow in year 0, bracket 1 plus the growth rates divided by K. K is your work minus G. Do you agree with this? The two formula is the same. Cash flow in year 0, bracket 1 plus the growth rate will give me cash flow in year 1. Look at it. This is what we are saying. Your CF1 is the same as CFO bracket 1 plus growth rate. Please, do we understand this concept?
The 1 plus growth rate is what is similar to the dividend valuation model, where, for instance, there's a consistent growth in dividends. And we're using that growth rate to infinity to calculate the cost of equity. I remember that. So we'll now say dividend bracket 1 plus G all over market value.
You are very correct. This can be derived from cost of capital. Now, examiner says the current corporate value, as our current corporate value, where's my cost? Where's my line? Our current value is 763. Cash flow is equal to earnings before interest and tax, bracket 1 minus tax, close your bracket, minus plus depreciation, minus capital spending. This is given to us in the question.
We're sorry to take you back. This formula, the denominator, personally, I don't understand this denominator. The upside, that is the cash flow times 1 plus G. This K minus, this K is the cost of capital. Then we're subtracting the growth rates. That is not very clear. Well, I just don't know why we're subtracting it.
Assuming you want to calculate cost of equity using dividend valuation model.
Yes.
And there's growth rate, Abi?
Yes.
The formula will look like this, Abi. Cost of equity is equal to your dividend, Abi?
Yes, bracket 1 plus G.
1 plus G, Abi?
Yes.
Divided
market
by
value.
Market value, Abi? So our market, let's say our market value is M.
Correct, yes.
Plus what?
Oh, yes. Okay, fine. I forgot the plus G. It's fine now, sir. It's fine.
Yeah, I hope it's fine.
Yeah, it's fine now.
But it's okay. You know, for me, if a student is asking questions, you are helping so many students. Some students actually don't ask questions in the class. They might not go back and start to read it on their own. Or probably they will now chat you later to ask questions. So for one student asking questions, you are helping a lot of students. All right, we have just brought in, this is what we're actually using. Your free cash flow is actually your dividend. What you pay to shareholder as dividend is the free cash flow. Cash flow we are not using for anything. We now transfer it to shareholder as what? Dividends. So I'm going to take this off. Now, let's continue. Now look what it's costing now. It's so tiny. Now I want to get my free cash flow. My free cash flow. If you look at the question, if I come here, earnings before interest and tax, 90 million. I'll pick it. My tax rate, 30%. I'll pick that. Depreciation, 20 million. Capital spending, 20 million. We can derive our free cash flow. Can come back here. Earnings before interest and tax, EBT, EBIT, 90, bracket, 1 minus the tax rate, 0.3, plus depreciation, 20, minus capital spending, 20. Please compute your free cash flow. That is free cash flow in year 0. Work that out. You are going to get 63 million. We have gotten corporate value. Corporate value, the current market value of the company is 763 million. The free cash flow currently is 63.
Sir, I have a question. Sorry, sir.
Let's go ahead.
Sir, please, why are you adding depreciation? I really don't understand this.
Please, I have not done any magic. Okay, why am I suppressing capital spending?
Why are you adding depreciation?
Okay, let me ask a question. If you are doing your cash flow under your cash flow analysis in CR, if you get to operating activities, are you not going to add depreciation back to your profit? You didn't get my point. I will answer that question again. Now look at it, please. The question says free cash flow may be estimated using, I hope you can see it, using earnings before interest and tax into bracket 1 minus tax plus depreciation minus capital spending. The examiner gave you a clue on how to compute your free cash flow. Is that clear, please?
Yes,
Hello?
sir. Yes, clear.
Now, let us assume you are not given a clue and you want to calculate free cash flow. If you are doing in your CR, if you are to prepare a cash flow statement, we have operating activities. We have investing activities. We now have financing activities. From your operating activities, you are going to pick your earnings before interest and tax. Then what are you going to do to depreciation?
It's true, you add back depreciation.
Add back.
Yes, thank you, sir.
Is that clear? The examiner,
Yes,
the
sir.
examiner has done us a favor by telling us what to do. We had bad depreciation. Depreciation is a non-cash item. We had it back. All right. So I don't need this. I want to erase this off. It's just to explain. We have the current market value. We have the free cash flow currently. What is the existing WACC? What is the existing company's WACC? The existing WACC.
12.96.
Thank you. The existing WACC is 12.96%. That means I know and we have been told that K is equal to WACC. This is equal to 12.96%. Can we derive the growth rates? We have the corporate value. We have the free cash flow. We have the WACC. Can we derive the growth rates?
Yes.
Because examiner says, why are we interested in the growth rates? Examiner says the growth rates will not change. Look at it. This question is a bit tricky, show. Look at it. The company's growth rate of cash flow may be assumed to be constant. That means I want to know that growth rate that is constant and is unaffected by any change in capital structure. So I want to know that growth rate that is constant, because I'm going to require that constant growth rate to go to new capital structure to calculate value at new capital structure. So I must know the growth rates at the existing capital structure. The existing capital structure is 60% equity, 40% debt. Please, 1 minute. All right, just to take water. The existing capital structure is 60% equity, 40% debt. At this capital structure, value of the company is 763 million. Cost of capital of the company is 12.9%. Now, I want to calculate value of the company. If the capital structure is 80% equity, 20% debt. For me to do this, I must know that growth rate that will not change. So the first thing we are trying to do is to get the constant growth rates. We can come here now. Can come here and say, okay, I want to know, I will take it as working 10. estimate growth rates. I can come here now. Corporate value is 763 is equal to free cash flow is 36 bracket 1 plus G. I don't know the G yet. Divided by WACC is 12.96%. That becomes 0.1296 minus the growth rate. What is G? I can cross multiply. Is that not? That becomes 763 bracket 0.1296 minus G is equal to 63 bracket 1 minus G. This is G, please. You can open a bracket. You can open a bracket. 0.1296 multiplied by 763. What do you have?
$98.8848.
Also, this is disturbing me. 98.885, right? Approximately.
Yes.
Minus 763G is equal to, open the bracket here. 63 minus 63G. Is that not? Is that not, please? Collect light terms.
So is that not supposed to be 1 plus G?
Just 1 minute. Oh, sorry, it's plus G. It's plus. We can continue. Let's collect light terms. This becomes $98.885. I'll move this here, become minus 63 is equal to 63G plus, this we move 763G. Please work this out. 98.885 minus 63. What do you have?
35.87.
I can't hear you, sir.
35.87.
25.
No, 35.87. 885.
85 is equal to, please sum these two together.
826.
82.
826.
826G. Therefore, our G is equal to 35.885 divided by 826. What is your G, please? You are going to get 0.043. Please work it out.
It's correct.
That means if you take it to percentage, the growth rate is 4.3%. Our G is 4.3%. You have gotten the growth rate. That growth rate is not going to change. Without resolving the growth rate, you cannot calculate corporate value at the new capital structures. Without resolving the growth rate, you cannot calculate corporate value at the new capital structure. We cannot go round up now. It should be page 10. I'll share a new page. In case you are not seeing this, please speak out. You can now come here. Corporate value at 1, 80% equity. And 20% debt. I'll state the formula for corporate value. Value is equal to CFO brackets 1 plus G divided by K minus G. My CFO as computed is 63. My G as estimated is 4.3%. 4.3%. Cost of equity. If capital structure is 80% equity, sorry, cost of debt. When I say cost, my WACC, K is equal to WACC. It is the WACC that matters. WACC. Now, if equity is 80% and debt is 20%, what is WACC?
13.15.
You just bring it in here. You come here and say WACC. This is 13.15. You can calculate value here now. Look at it. Value is equal to 63 bracket 1 plus the growth rate, 0.043. Close your brackets over WACC 0.1315 minus 0.043. Please compute value and give us answer. What is value at we should have something like
742.47.
743 million. If the new capital structure is 80% equity, 20% debt, total value will be 743 million. We go to scenario 2. Corporate value at scenario 2 at 2. 40% equity, and 60% debt. State your formula. Of course, in the exam, you don't need to start wasting time. Just come and I'm explaining. My value is equal to CFO bracket 1 plus G all over K minus G. The CFO is 63. That will not change. The growth rate is 4.3%. Then our K. What is WACC? If the capital structure is 40% equity, 60% debt. Is that not?
13.47.
Good. I can now say corporate value. Value is equal to 63 bracket 1 plus the growth rate 0.043 divided by the WACC 0.1347 minus growth rate 0.043. Value $717. Please check it out.
Correct.
Now, what's our observation now? What has happened to corporate value? By changing the generation, what happened to corporate value? Because you are going to commence. Let's show result at a glance. I'm only doing this. I want all of us to be able to comment. Summary of results. Summary of results. I have, let me use red here. I have existing, even pick. I have existing capital structure. It always takes space. This is equity, 60%, and debt, 40%. The cost of capital here was $12.96. Corporate value $763 million. New capital structure. New capital structure. I have Roma figure 1. Or where is this? You can't sense it. Why? I have 1. I have 2. This thing is disturbing my life. I'll come back here. Yeah, 2. Under here, cost of equity is 13.15%. Value is 743. Yeah, 13.47%. Value 717 million. So, what is your recommendation and comment? What should the company recommend capital structure the company should adopt? Yes, Debbie.
It's still the existing. It's still the existing. When we did that cost of capital, we found out that the cost of capital for the existing was the lowest. And it's reflecting in the value of the company. The valuation of the company is the highest with the same existing structure that produced the lowest cost of capital.
That is what traditional theory of capital structure is explaining. That capital structure have impact on market value. How a company combine equity and debt in its capital structure will have impact on your value. If the company used 60% equity, 40% debt, cost of capital is 12.96. It is lower or the lowest. The traditional theory of capital structure says there is an optimum capital structure where the weighted average cost of capital is minimized and the value of the company is maximized. The traditional theory of capital structure says that there is an optimum capital structure where the weighted average cost of capital is minimized and the market value of the company is maximized. Once the optimal capital structure is achieved, then the company should stop introducing debt finance. So at this existing capital structure, 60% equity, 40% debt, optimum capital structure has been achieved. Any attempt to change the capital structure will affect the company. We are done with the part A of the question. But the part B is just theory. Examiner says part B. If there's no question, let's round up. Part B, discuss possible reasons for errors in the estimate of corporate value in part A above. 10 marks. The corporate value we have calculated. What are the possible areas of errors? Look at the response. The estimate of corporate value are only approximation and may be incorrect for many reasons. That estimate we have done is an approximation. It's not the exact value and may be incorrect for many reasons, including one, the assumption of constant growth may be incorrect, that cash flow will grow to perpetuity at 4.3%. That may be incorrect. Number two, the corporate value in this model is sensitive to level of capital spending. The corporate value is sensitive to the level of capital spending, which might change or alter considerably from period to period. Capital spending can change from 1 year to the next year. Number three, the model ignores the cash flow impacts of any changes in working capital. Number four, corporate cash flow will be better estimated using this equation. When you get to business valuation, when we explain, the next lecturer will explain how to estimate free cash flow. Number 5, any changes in GERI will involve transaction costs. Next, repurchase of shares might not be possible at the current market price. We can take one, but you must be able to present at least 5. I'm done with the question. Any question, please? We can enter new topic again, sir. We'll start next week. Any question, please? If there's no question,